The new Too Big to Fail, Too Big to Exist proposed legislation from Senator Bernie Sanders is short and to the point. The largest banks and other highly leveraged financial institutions are simply too big and pose a real danger to our continued economic recovery.
If Wall Street does not end its greed, we will end it for them.
Make them break up into smaller pieces, bringing more competition, better service, and lower risks for the American economy. In September 2008, following the collapse of Lehman Brothers, it became painfully clear that some financial institutions such as AIG, an insurance company, Goldman Sachs, an investment bank, and Citigroup, a bank holding company, had become too big to fail, meaning that US government officials were afraid to let them go bankrupt due to the likely knock-on consequences for other financial firms and for the rest of the economy.
The plane that we flew in on this morning, leased from AIG. Construction downtown, AIG. Life insurance, 81 million policies with a face value of 1.9 trillion. Billions of dollars in teachers' pensions. It's everywhere.
Consequently, the George W. Bush Treasury Department proposed what became an enormous lifeline for big firms, and this policy was continued when President Obama came into power. The bailout did save these large firms from collapse, but the economy still suffered the largest recession since the 1930s, and millions lost their jobs.
You want too big to fail? Here it is.
At the same time, the Bush-Obama financial measures included hardly any support for ordinary Americans who were struggling with their mortgages. The result, the executives running the big banks were able to stay in business until asset prices recovered and have pocketed huge amounts in compensation and bonuses. At the same time, millions of ordinary people were forced into foreclosure, even though many of them could have stayed in their homes if they had received the same terms of support that were extended to big Wall Street players. This massively unfair outcome has only exacerbated inequality across America. Since 2008, our largest banks have actually become bigger, with balance sheets in the trillions of dollars, and are hence more likely to cause negative systemic consequences if they were to fail. The biggest US bank in 2008 was Citigroup, with total debts around $2.5 trillion. JP Morgan Chase is the largest bank in the world today, with total debts close to $3.5 trillion. The potential negative consequences from a big bank failing are a form of implicit blackmail.
Greed, fraud, dishonesty, and arrogance. These are some of the words that best describe the reality of Wall Street.
Bank executives have the incentive to take a lot of risk, resulting in nice paydays for them when things go well. When problems occur, there are big losses, but someone else, the government, has to deal with those. If you let such banks fail, global financial cataclysm will likely follow. If you save them, as was done in 2008-2009, you are just encouraging them to do it again.
The lead lawyer at the Federal Reserve, Scott Alvarez, their general counsel, says the perception that some institutions are too big to fail reduces the incentives of shareholders, creditors, and counterparties of these firms to constrain excessive risk-taking.
Some safeguards were put in place by the Dodd-Frank financial reforms, but these are likely to prove inadequate. Senator Sanders' legislation cuts to the heart of the matter by putting a size cap on the largest highly leveraged firms.
If a bank is too big to fail, it is too big to exist.
The size cap is simple, straightforward, and transparent, limiting the systemic footprint of a firm to 3% of GDP, which is about the largest scale on which a failure could be managed under the Systemic Resolution Framework designed by the FDIC. This measure will bring us closer to full and fair competition in the financial system, where a few megabanks currently predominate. When Lehman Brothers failed, it had total liabilities above $600 billion and a full systemic footprint, as measured now by the Federal Reserve and as referenced in this legislation, that was likely in the $800 to $900 billion range. Senator Sanders proposes to cap the size of banks and other financial firms with high leverage, a lot of debt relative to equity, at around $600 billion, which is really the largest entity you could imagine the FDIC would be able to handle smoothly in the event of a failure. Primarily, 6 very large banks would be affected by this legislation: JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley are all large enough to pose an existential threat to our financial system. Some large insurance companies may also be affected, although determining this precisely will require some more analysis by the Federal Reserve, which is also mandated in the legislation. The rest of the financial system will benefit greatly from increased competition and a more even playing field that reduces the political influence of the megabanks. Senator Sanders is proposing an entirely reasonable and mainstream idea that should attract broad support. As former Federal Reserve Chair Alan Greenspan put it in October 2009 when discussing the largest financial firms, if they are too big to fail, they are too big.